On July 4th, President Trump signed into law the One Big Beautiful Bill Act, packed with changes that could affect your taxes, your paychecks, and even your family's finances. Let's dive into what's new, what's staying the same, and how it all impacts you. During his first term, President Trump signed into effect the 2017 Tax Cuts and Jobs Act, which made a lot of big and sweeping changes in the tax law. However, a lot of those provisions have been phasing out or were set to sunset, in other words, expire after this year or next year. A big part of Trump's campaign was extending a lot of these laws that he had created in the first place under his first term. The reality of this is not so much that the tax law has changed with this new tax bill, but instead it's provided a lot of certainty because we didn't know whether these provisions would actually be extended or not. There are a lot of new provisions, but the big news is actually on what stayed the same. So first, let's talk about the tax rates. During his first term, the tax rates were lowered. We had a top rate of 39.6%. It was lowered to a top rate of 37%. Absent any changes, those tax rates would have gone up again. However, the new law extended those rates. Additionally, the standard deduction was increased substantially during the previous tax law, and that is staying the same. What that means is that much less people are itemizing their deductions than they were before, because the standard deduction is basically just a flat deduction that everyone gets instead of taking deductions for things like your mortgage interest expense or charitable donations, medical expenses, and state and local income taxes. Speaking of state and local income taxes, that is one of the things that changed a little bit. It has been highly debated, especially in high tax rate states, that the SALT cap, or the state and local tax cap, should be increased because that cap has been $10,000 since Trump's first term. For those that don't know, state income taxes or real estate taxes on your personal residence are deductible. However, that was limited to this $10,000 limit under Trump's first term. For those that are in high income tax states, they get phased out earlier and they missed out on these deductions. Under the new law, the limit was increased dramatically to $40,000, but it's still going to trap a lot of people. One little strategy tip, if you're caught in this, is to look at the pass-through entity tax. This is where states actually created a workaround to avoid that limitation. The workaround essentially involves electing to pay state tax at the entity level for any pass-through entities. So this would be S corporations and partnership entities. You could look at the business income passing through and elect to pay the tax at that level. If you did that, then the deduction came through on the K1 from that business and avoided the SALT cap limitation. While the limitation has been increased, it still may mean that it's beneficial to use the pass-through entity tax just based on other limitations involved with itemized deductions. The change of the SALT cap follows the trend of a lot of the changes we have, where it's really just an enhancement of something that was already in place. For example, the next thing is bonus depreciation. This was 100% back in 2022 and for many years before that. However, it started phasing down over the last few years, and in 2025 you would only have 40% bonus depreciation. Next year there would only be 20%, and then it would be gone. The new tax law increased it back up to 100%, which was great for businesses and especially for real estate. Bonus depreciation essentially allows you to write off the purchase of large assets in the first year rather than having to take that deduction over many years. Another enhancement was the 163J interest limitations. And what's crazy about this is I remember during the first time Trump was elected, leading up to the election, there were all kinds of articles about how real estate investors and businesses shouldn't be able to take interest deductions. It didn't actually talk about depreciation deductions, which was always crazy to me because interest expense is an actual cash outflow for real estate and other businesses, while depreciation a lot of times doesn't actually represent an expense. This concept is driven home in the real estate industry because a lot of times you're financing real estate with debt, meaning you don't actually put out cash for the entire purchase. Maybe you're putting in 20 to 40% of the purchase price. The rest is financed by a bank or someone else, but you're still allowed depreciation deductions. And on top of that, the depreciation may not actually represent a true decline in value. Sometimes it does, sometimes it doesn't, but most of the time over the long term, real estate is actually increasing, but you're able to depreciate it as if it's losing value. While the new law enhances that, they actually started limiting interest expense, which was crazy, but nonetheless, that's what they did. For the past few years, in order to calculate the interest expense limitation, you would figure your income, which included deductions for depreciation and amortization, and you would take a percentage of that, more specifically 30% of that, and that would be the most interest expense that you could deduct. However, with a new tax law, in order to calculate the limitation, you can add back depreciation to your income, meaning you have a higher income number that you take 30% of. So in effect, you can deduct more interest expense now. If this is going to affect you, especially if you're in the real estate industry, you should look at the electing real property trade or business election. Of course, there are some trade-offs, so you'll want to consider those with your advisor. Another enhancement of something that was going to expire is opportunity zones. We had opportunity zones where there were incentives to invest in certain designated zones, and if you held those investments for at least 10 years, you wouldn't have to pay any tax on the appreciation. That was set to expire at the end of 2026. However, now we have an Opportunity Zone 2.0 where new parcels will be designated and you'll be able to invest in those. It's a very similar type tax benefit, but there will be some changes. Another big change is the research and experimental expenditures. Previously, I had to amortize those over 5 years. Now you can take all of that as a deduction in the first year. Of course, a couple big changes that Trump talked about when he was campaigning is the no tax on tips and the no tax on overtime. It didn't quite end up how he campaigned, where it was no tax on them, but there are deductions for it. You get up to $25,000 that you can deduct in tips that people are not taxed on. That phases out over certain income thresholds. It's the same thing with overtime pay. You get a $25,000 deduction, which also will phase out at certain income levels. The child tax credits saw an enhancement by a couple $100. Those were set to go down next year. We also saw the addition of the senior deduction, which added a deduction of $6,000, regardless of whether you were receiving Social Security or not, which, by the way, he was campaigning on no tax on Social Security. That did not end up in the new tax bill. A new deduction was added for auto loan interest up to $10,000 for certain qualifying vehicles, which really means that they're manufactured in the US. This was part of his bringing jobs back to the US and incentivizing that. We saw good and bad changes with charitable donations. For those that don't itemize their deductions, they're allowed to deduct up to $2,000 if you're married filing joint, or $1,000 if you're filing single. For those that do itemize deductions, we saw the opposite, which was a reduction in the benefit. So now there is a 0.5% floor before you can benefit from that. And that basically means you look at what your adjusted gross income is on the tax return, and this is your income before most deductions, and you take 0.5% of that. Until you have made more charitable donations than whatever that dollar amount is, you will not benefit. As an example, if you made $1 million and that was your adjusted gross income, then your floor would be $5,000. That means you would have to contribute $5,000 before you saw a benefit. If you contributed $6,000, you would only be able to deduct the amount that exceeded $5,000, which is $1,000. Gambling losses were also limited. You used to be able to deduct losses up to the amount of your winnings. Now you can only deduct up to 90% of those losses. The estate and gift tax exemptions were extended. The high thresholds were set to lower substantially going into 2026. So we were going to see them drop down to about $5 million. Now they're going to be almost $14 million, and they're going to be inflation adjusted going forward. And lastly, something to help out just with the compliance is the threshold for 1099 reporting will be increased from $600 to $2,000. For those that don't know, 1099s are required to be filed when you have a trade or business and you pay someone or a business to perform services for you. Since there were a lot of provisions set to expire at the end of this year, Your tax planning may have changed as a result of this tax bill, so I encourage you to work with your advisors and start tax planning now before it's too late and you can make some changes before the end of the year, especially if you're able to use bonus depreciation to offset some of your income. With the increase in bonus depreciation, it means you could buy less assets in order to offset any income.